The other thing he did that we could do today, and I think we should do today, was Hoover had set up something called the Reconstruction Finance Corporation, which was a a government-owned lending facility. The point of it was to try to bail out the banks, but it was making loans to the banks under Hoover, but that didn't work because they didn't really need more loans. They needed customers. They needed a thriving economy. So Roosevelt took that same engine and used it to fund projects that would put people back to work. So that was the basis. That's what funded the New Deal, including Fannie Mae and many the Homeowners Loan Corporation and all the dams and all the projects we've heard about that put people back to work during the New Deal. And then the engine really got put to work with World War II, where they funded all this development of tools and machinery in order to make airplanes to fight World War II. And those tools set us up to be an industrial power for the second half of the century. The only problem with the Reconstruction Finance Corporation was that it was funded with government debt originally. I mean, it was they issued bonds and then they sold the bonds and then the money was lent out. So the way you could fix that started off our federal debt that's been growing ever since. But the way you could avoid that, and what I think they should do today, is to lend in the same way that banks do. Just create the money. You can just create credit and lend it to yourself as a government. You could even lend it to yourself interest-free. That's what Australia did. Their bank, the Commonwealth Bank, was owned by the government, their central bank, during the Depression, when everyone else was experiencing a depression. And they made loans to themselves at 0.5% interest and funded development, and in that way avoided the depression. And so did New Zealand. After the Depression, the Federal Reserve took upon itself to avoid any further depressions, and the way they did it was to continually expand the money supply. Every time there was a threat of a recession, they would just pour money into the system. And so of course they expanded it by increasing the debt. So here you have, for instance, the savings and loan collapse in the 80s was overcome with the stock market boom of the 90s, and that was done by lowering interest rates. And then in 2000, you had the collapse of the dot-com collapse. And to overcome that, they created the housing bubble, which was done by lowering interest rates to very low levels and by relaxing lending standards, which basically meant eliminating lending standards so that anybody that walked in the door could get a mortgage whether they qualified or not. And you can see from this alarming curve here that it's another exponential curve that's out of control, or it was until it hit the wall. Because they were lending to everybody in sight, that meant that the banks would be assuming a great deal of risk. And so to avoid that risk, they moved the loans off their books by selling them to investors. They'd package them up into mortgage-backed securities and collateralized debt obligations, chop them up into pieces, and sell them. So where it used to be just a deal between the borrower and the lender, now you have all these other parties involved. So you're getting farther and farther away from the borrowers. The lender is getting farther and farther away from the borrower. So the bank goes to a third-party intermediary, and then they arrange this mortgage-backed security, and then it's sold off to investors. And then it's protected with derivatives, and that's called the collateralized debt obligation. And they're buried in these SIVs, special investment vehicles. So this remoteness, that's one thing we can do. There's a lot of potential for lawsuits in here, but I don't have time to go into that. But that is one thing we can do to get back our money system. For instance, the homeowners, actually, most homeowners have a good defense to foreclosure, and that is that these securities holders, the trustees for the securities holders, don't actually have the paperwork that they need to foreclose because these things have been sold and resold so many times, and they don't. The mortgage didn't follow them. So to induce the investors to buy these dodgy mortgages, They were protected with something called derivatives, which are basically just bets, but they were sold as a form of insurance. So the big one for default is collateralized debt obligations, which are up to 62 trillion on the banks on the books of U.S. banks. According to the Bank for International Settlement, as of last December, these bets became so popular that they were actually up to, this is not 500 billion, this is $500 trillion last December. And now, according to the Bank for International Settlements, they're over a quadrillion. That's 1,000 trillion. The gross domestic product of all the countries in the world is only 60 trillion. So this is obviously an out of control, impossible number. That's actually just the derivatives trades. There are different ways of counting the derivatives, but no matter how you count it, even if you only look at 62 trillion, that's still more than than the gross domestic product of all the countries in the world. So how are those numbers even possible? It's because derivatives are just bets, and you can bet any sum that you want. So, for instance, on General Motors, I think there's something like 10 times the amount of bets on General Motors defaulting as General Motors is worth. So they just hyperinflate the value of things. So obviously this is another exponential curve that's about to hit the wall. You can't keep that up forever. One commentator used the example of a parasite in a jar. If you had parasites in a jar that doubled every minute and you started at 11 p.m. and they filled the jar completely at midnight, at what point would the parasites feel like they had plenty of room left to grow where the jar was only half full? The answer is 1 minute to midnight. So when you're at this part of the curve, at first you go along and everything seems fine. Like this would be the first, if you counted this as 1940, the World War II, it looks fine for a while. And then it shoots up like this, and this is where it hits the wall. You just can't go any higher, and that's where we are, 1 minute to midnight. So the Federal Reserve and the Treasury, their approach to all this is to clean up the bank's books that are holding all these dodgy securities by trading them for our good U.S. debt. In other words, we're going heavily into debt in order to clean up their books. But that means we, the taxpayers, are paying interest on these bonds to the banks, which are trading them for their toxic collateral. We get the toxic collateral, and we're paying interest for the privilege of getting it. The bankers are obviously doing what the Federal Reserve was set up to do, which is to save the banks, but they're not saving us. We, the borrowers, we the taxpayers and the investors are going down with the ship while the bankers are getting out. So what should we do about it? Jefferson said, "I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people to whom it properly belongs. We should create the money, not the banks, and that would fix the whole system. We could clean up the books." But everybody says, well, if the government could create the money, wouldn't that be highly inflationary? Here's a chart from an excellent website called shadowstats.com, where he tracks the real statistics, not the ones that the government has manipulated. And you can see here, this goes back to 1665. You can see that we didn't really have inflation during all that time when they were issuing the Continental. They were issuing their paper script. And during the 19th century, when the reason they didn't have inflation, of course, was that they would periodically have these depressions because it was linked to gold, and gold was a tether that kept the money supply from expanding too much. We only really had this serious inflation since we've had the Federal Reserve printing money. So it's our borrowed money that has put us into hyperinflation, not the government printing money.